Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, July 18th, and then we'll see how things look for Wednesday, July 19th. We had another up day. If we were overbought yesterday, we're even more overbought now. That just shows that the market has good solid momentum, which we're seeing in some of our charts. We're even more extended to the upside, so the more we do this, the more likely we're going to get a pullback at some point. We're just kind of waiting for a trigger for that to happen. When it does happen, then we'll just have to evaluate things and say, okay, are we just falling back and regrouping before we get set to go higher? Or as this unfolds, we'll just start to evaluate things and then say, okay, it's turning more negative. So we might actually switch downward, but we don't know what's going to happen yet. So far, the charts are holding up. We're making a lot of 52-week highs in many different areas. A lot of the folks that were really negative on the market, they're like, oh my gosh, I didn't think this was going to happen. Well, it has happened, and it just shows, as the old saying goes, the market can remain irrational for longer than we can remain solvent, especially if you were short the market. If you're long the market, you're enjoying this for right now. Let's go back and talk about what happened. Right at the open, we had a higher open. Prices climbed above R1 at 45.35, and then we got above R2 at 45.48. As the day went on, prices climbed above R2 and then just closed slightly off of the high. So we saw a little bit of selling going into the close. We were up 0.71%, and volume was above average. We're seeing that pick up now, that we're breaking out a little bit here, so that could be encouraging. The technicals are positive, but we're overbought in the short and intermediate term. It has everything to do with inflation and interest rates right now, and so far, looking forward, the growth concerns seem to be more optimistic. What are some comments that we can make? The mega caps did start the day kind of weak. That's when we were chopping around earlier, but as the day went on, buying really started to come in for a strong finish. Small caps had a good day on Tuesday. The transports, this is what we were kind of concerned about. It had a strong day. It was up 2% and also set a 52-week high. The S&P made another 52-week high. The positive scenario that seems to be pervading right now is that we will have a soft landing, meaning that even though we're seeing economic slowdowns, we will not necessarily go into a recession. They're also believing that the Fed is almost done raising interest rates, and looking down the road, future earnings growth seems to be positive. Now remember, any of these scenarios can change at any time. The market is really capable of switching fast. On a short-term basis, we have our CMB composite that's extreme positive, and then the whole list here, the CCI 14 and 20, the Stochh RSI, the Williams percent R, the standard deviations chart, our stochastics, the boom based on 20 periods, and the RSI based on 9 periods. Intermediate term, the list is also growing. We have the balance of power, the Erin indicator, the rate of change based on 50 periods, the PMO studies, oscillators. We're still seeing some negative divergence, but they keep going up, so they may blow out that divergence that we've been seeing. The Sean trend meter, the bullish percent index for the S&P 500 as well as the NASDAQ 100, the percent B indicator based on the Bollinger Bands, our boom indicator based on 50 periods, and the RSI 14. The dollar was up a little bit because it's really been getting hammered lately, and interest rates were also down. All of the yield curves, though, still remain inverted. We're not seeing a shift there yet. Sentiment is even more extreme now. It had been at 80, now it's at 82. Our trend is positive. The green line's turning back up, so it's advancing. It's above its moving average, and we're also above 20. So we're in a solid uptrend, but we're getting kind of high with that chart. Doesn't mean we have to stop here. We just want to take notice of this. Our bias and momentum still remain positive. Looking at the economic reports that came out, first we had total retail sales. They were up 0.2% month over month, but they expected it to be up 0.5%. Last time it was up 0.5%. When you take out automobiles, we were up 0.2%. They expected it to be up 0.3%. Last time it was up 3%. Total industrial production was down 0.5% month over month. They expected it to be unchanged. Last time it was up 0.5%. Capacity utilization, we're dropping below 80 at 78.9. They expected it to be at 79.5. Last time it was at 79.4. Business inventories were up 0.2% as expected. Last time they were up 0.1%. The NAHB Housing Market Index came in this week at 56. They expected it to be at 56. Last time it was at 55. Here are some charts to show you. Here's the core retail sales year over year, showing how we're flattening out a little bit, suggesting that we're seeing a bit of a slowdown economically. Here's the month over month. Even though they were up, they did decline from the previous month. Looking at production and capacity, the blue line is production, where it is trailing off. Then we look at capacity utilization, where it is declining on this chart. Industrial production, month over month, is declining. It's coming down from where it was previously. The business inventories were a little bit above zero, but we have been declining overall. And the NAHB Housing Market Index did see a nice increase. Looking at the IsabelNet.com blog charts, the first one just shows the consolidated equity positioning. Folks are getting more into stocks. It's above zero. The S&P 500 level in earnings per share put out by Goldman Sachs, if we see the kind of forecast that they're projecting, they also expect earnings to continue to climb. If they stay about the same, we'll be at 4,500. Right now, we're at 4,510. Then this is interesting. It says we have cut out our recession probability further to 20%. This is Goldman Sachs. They had been at 25%. They lowered it down to 20% now. Not much of a change overall, but we're starting to hear more talk about that. Folks are coming down with some of their projections that we may go into a recession. There's still lots of evidence out there that suggests we may go into a recession, but we're also starting to see lots of evidence that we won't. The market will ultimately decide what happens, and then we have to look at some other charts that the government uses to define whether we're in a recession or not. The sentiment indicators also suggesting that we're extreme positive right now, and that's lining up with the other indicators that we look at. But folks are tending to decrease their exposure to stocks. They saw some trouble on the horizon and looked at getting out. We look at the technical overbought and oversold composite put out by SimpleVisor. We're getting a pretty high reading now. We're at 90. A lot of times that's about where this tops out. Again, with some of these indicators, if we can camp out around this level for a while, that suggests good solid momentum. Even if we pull back, if this doesn't come down too much, that might suggest that momentum can still continue. What's the most crowded trade right now? Everybody's in long tech. A lot of folks are getting into Japanese stocks as well, but most of the real fuss right now continues to be tech stocks. Manufacturing data shows that profits are under pressure. We're seeing a decline in the ISM manufacturing. That's the darker blue line. And then the U.S. 12-month trailing earnings per share growth is also declining. This is one of those we might go into a recession kinds of charts. Earnings per share fell in the second quarter 2% just over the last 3 months. This shows how things have been coming down. But what we're kind of seeing as the earnings per share forecasts are adjusted, they tend to adjust them kind of low. So then when the company comes out with their earnings, it's like, wow, they beat estimates. Oh my, let's send their stock price going higher. Then we're looking at the EBT margin. This is ISM Manufacturing Prices Paid Index with a 3-month moving average, and then they lag it by 6 months. Where the dark blue line is the EBIT, which is earnings before taxes and interest. That's been flattening out, but still coming down. And then the prices paid index has also been declining. Another suggestion that we're not out of the woods yet economically. Getting into our charts and analysis. Here's the intraday chart where we had a higher open. We got up above R1, then we went up to R2 eventually. We actually climbed above R2 and then saw a little bit of selling going into the close. Here's the intraday chart. We were flat in the initial overnight session. We bumped up a little bit, but saw some weakness in the pre-market session. Then it was after the market opened when things really took off and were pretty much flat in the initial overnight session. Looking at growth versus value, where growth did underperform value. Both of them are still doing quite well, but value did outperform. On a closing basis, growth underperformed value on the large caps, also with the mid caps and the small caps, even though they were all up. Here's our intraday chart with the SPY growth versus value ratio, where we saw some strength midday, but then it trailed off a little bit going into the close, and we actually finished negative. Sentiment, still showing that there's not a lot of fear when we look at our Ulcer Index. The VIX continues to decline with the line chart and the bar chart. The VIX of the VIX is showing that volatility of the VIX is slowing down. We're looking at the VIX to S&P 500 correlation. After spiking up, it's starting to come back down. Is this going to be more positive for the market, or is it going to turn into something more negative? The equity put call ratio, it continues to decline overall, but we did see a little bit of a tick up from Monday to Tuesday. The equity put call ratio longer term continues to decline. That's positive. Looking at the MOVE index on top, where bonds were down slightly, so we saw a bit of a tick up with the MOVE index. Stocks were up, so we saw a bit of a decline with the VIX, but the relationship between the two is still very strong. The VIX to MOVE ratio also shows that there's not a lot of fear. Looking at this other fear gauge, we're back to declining overall, showing that there's not much fear, and our other fear gauge also continues to decline. Folks are still favoring the risk-on posture with this ratio continuing to climb. The advanced decline line studies. Some of the worries that we had yesterday, well, we seem to improve that a bit. We climbed higher based on price and volume. The new highs, still a little bit of a concern. They're breaking out and we're seeing a lot of new highs, but our 5 period is flat, although our 10 period did turn back up slightly. The advanced decline ratio ticked back up slightly and is positive since it's above 0. Accumulation distribution still looks positive. We saw some improvement with the cumulative advanced decline line for the NYSE, and with the NYSE regular advanced decline line, that also has shown some improvement. This other advanced decline line that we look at is still holding up. Where we look at common stock for the advanced decline line, we're coming back to a previous high now. We're still lagging a little bit based on volume. When we look at our advanced decline line studies, pretty much across the board we saw improvements. Our trend, we are positive. The ADX is going up. It's above its moving average. So we're in a trending environment. We're not quite up to this 40 level yet, but the green line is above 40. However, it has turned back up, so we still default to the positive. Our shorter term ADX is also starting to get a little more extreme, with the green line also above 40 and advancing. Volume is picking up a little bit. We were actually a little above average. Our short-term charts, we're starting to come up to the underside of this trend line. We're seeing if that's going to offer some kind of overhead resistance. We did get a little bit above this dashed pivot line here, so that is positive. On the bottom, you can see where volume did pick up to above average. We're still above our double and triple exponential moving averages based on 20 periods. That's looking solid. We actually came down a little bit with our 20-period exponential moving average. We were flat to slightly declining with the 50, and we were flat with the 200. The Stochc RSI continues to be extreme positive, as is the Williams percent R, the CCI 14, and the CCI 20. Even though both of those declined a little bit, they're still in extreme positive territory. Our stochastics, overbought across the board in the short term, intermediate term, and long term. Force index going back up, looking more positive. Some intermediate term charts. We're above this black line with the balance of power, even though we ticked down slightly. We're getting a pretty extreme reading. The CMB composite also above the black line, getting rather extreme. We're above the 50-period double and triple exponential moving averages. So far this is holding up and showing nice momentum. The go-no-go system remains positive. And we're at the highest high level and advancing, so that's suggesting good momentum. The TTM squeeze is also turning back more positive. We are getting a little extreme with our percent B indicator, and what that does is it measures when we go outside of the Bollinger Bands. That doesn't happen very often, and when it does, it tends to not stay that way for very long. So this is another overbought indication. We're getting above the third standard deviation now with our chart here, suggesting that we continue to go up too far too fast. We're also looking extreme with our 20-period boom indicator and our 50-period boom indicator. What this indicator does is it measures how far away are we from the 20-period moving average, that's the top one, and how far away are we from the 50-period moving average. If we get too far away from those moving averages, they act like a magnet, which pulls price back to the moving average. The rate of change going back 50 periods, we're also looking more extreme positive. The PPO studies, this is a momentum study here where we're looking positive across the board. The ease of movement continues to show improvement. The Arun is continuing to be extreme positive. What we do is the green line on top, that means that buyers are in control. When the red line's at the bottom, that means that sellers are not having much of an impact. The difference between the two is the oscillator down below, and we're pegged up at the top now. The McClellan oscillator for the S&P 500 did turn back up. and the summation index continues to advance and we're breaking out above this previous high, we're showing a little bit of a lag based on volume, even though it did go up in Tuesday's session. The NYSE McClellan oscillator is also turning back up and is above zero. That's positive. So we're seeing some improvement with the summation index based on price and the summation index based on volume. This is another warning sign, but sometimes we get false signals from this chart. The Swenlin trading oscillator turned down based on price and volume. They're still positive because they're above zero. But sometimes this can be leading to us, but sometimes it also misleads us. The parabolic SAR system remains positive with the dots underneath. The PMO shows that momentum is going up based on price as well as volume. We're declining just a little bit with the percent of PMOs in the S&P 500 that are rising. We're pretty much flat with the buy signals. We're still going up a little bit with the PMOs that are above zero, suggesting good momentum. These other ones are suggesting that maybe we're slowing down just a little bit. The Elder Impulse system for the S&P remains positive with a green bar. The slope oscillator, our touchiest oscillator, has now turned back to positive. The MACD has also turned back positive. When you look at all of our oscillators, we're still a little bit concerned about this negative divergence, but we are showing improvement. We're not seeing as much with our longer-term tricks in KST, but the short and intermediate-term oscillators are turning back up. The Sean trend meter still continues to be extreme positive. The bullish percent index ticked down just a little bit, but it is extreme positive, suggesting good momentum, but at the same time, we're also showing an overbought indication. The NYSE bullish percent index does continue to show improvement. This is also an improvement that was kind of encouraging. The Chaikin money flow, it had been declining. Well, after Tuesday, it really shot back up. This tries to measure what's the smart money doing, and if they're getting in and buying, that could be a good thing for the market. The Chaikin oscillator turned back up slightly and is positive. The money flow index did go sideways. It's not quite extreme yet, but it is positive. The ultimate oscillator also advancing above 50. The vortex, the green line, continues to advance and we're above 1, so that's positive. The RSI, we might be able to get rid of this negative divergence, but we're still going back up and looking extreme positive with the 14 and the 9-period RSI. On balance volume continues to be positive. We're seeing a little bit of improvement here with our 200-day simple moving average study. We haven't quite been able to break above this previous high yet, and we're showing a little bit of a negative divergence based on volume. And when we look at the histogram chart, we're also seeing those same things, just something to be aware of. The Kopit curve has just generated a buy signal recently. I don't have any Fibonacci and line studies now because we remain in no man's land. So our different charts, the Heikin-Ashi chart continues to be positive, the Renko chart is positive, the Kagi chart is positive, and the 3-line break is positive as well. Our different indexes, the equal weight did have a good day, but it's continuing to underperform the S&P. On a ratio basis, it's showing improvement where both the equal weight and the S&P are going up, but still the S&P 500 has been outperforming. Then this is where we saw some good improvement. The Dow is finally breaking out above these previous highs, and that's looking pretty good. The transports were finally able to break out after spending 2 or 3 days going down. Both of these together give good support and confirmation of each other as well as to the S&P 500. The fact that the utilities were under pressure also gives some support to the S&P. Here's the transports to S&P 500 ratio. They were both up, so the ratio didn't go up all that much. We want to see this really continue to climb to show continued strength. When we look at the correlation between the S&P and the transports, it is improving, but it's not as strong a relationship as it can be. The transports and the Dow are performing about the same currently. Looking at our discretionary equal weight, we were up with the discretionary, we were down with the staples. Looking at our ratio, discretionary is outperforming staples. The Dow finally was able to break above these previous highs now. We have some overhead resistance at R1. The diamonds continue to be positive. The NASDAQ was able to get above this R1 level. Now we have R2 to worry about, but right now it's looking stronger. The cumulative new highs, new lows turned up just a little bit, but we're still in an overall decline here. When we look at the new highs minus the new lows below for the NASDAQ, we are positive. We're also breaking out above this previous high. We were able to get above R1 with the NASDAQ 100. Now we have R2 above current prices. The Qs still remain positive. The NASDAQ 100 BPI is starting to flatten out with the BPI. If this starts to roll over and come down, that could be a negative signal. The Qs continue to outperform the Dow, and small caps had a good day and were able to break above this R1 level. We're not quite at a golden cross with this chart that we look at. The Elder Impulse system for the small caps remains positive, and we're above this support resistance level. Now we're coming up to potentially another resistance level for the small caps. We're starting to look extreme with the RSI, but the MACD continues to be positive. The small caps are showing a little bit of improvement, but still are underperforming the S&P longer term. Small cap growth versus value actually declined a little bit, and we're chopping more or less sideways. Then when we look at the mid caps, we were able to break above this R1 level. So this is where we're seeing some more internal strength. The mid caps for the Elder Impulse system has switched now to positive, and we ticked down just a little bit with our ratio between growth versus value, but this is still showing overall strength. The FANG index continues to show more improvement and setting new highs. We're back above the previous high to set a new all-time high, and that is positive. The broad market of the S&P 1500 compared to shorter-term bonds continues to show that stocks are outperforming bonds. When we look at another broad market measure and compare it with further out bonds, stocks are also outperforming. The tech sector is outperforming bonds as well, and the S&P continues to outperform bonds, suggesting that we might see a soft landing. Growth continues to show strength and more improvement when compared to value. I have the bank ETF here, which it had a pretty good day. It was up over 3.5%, but it's still in an overall downtrend. The financial sector also showing some improvement. We're not quite back to a golden cross yet, but we are seeing some strength here. But when we look at the financials to the S&P, it improved a little bit, but we're hanging out around the 50-period moving average with this ratio. The regional banking ETF also showed some improvement, but is still in an overall downtrend compared to the financial sector. Looking at bonds, we were down a little bit based on yield and up a little bit based on price. We're seeing this ratio going down just a little bit. Folks are not quite as convinced to be in more risky bonds right now, even though they are leading overall. If this continues to fall, that might mean that folks are shifting back to more conservative bonds. They feel that they could get a good return that way without taking on the added risk. We're also watching the S&P 500 to the relationship with the long-term bond ETF. We're showing some improvement with the long-term relationship. We're getting a lot more improvement with the shorter-term relationship, but the spread between the two is still pretty strong. We want to see these line up more with each other, and they are showing some improvement. And then we're also keeping an eye on cash versus further out bonds. We're declining a little bit again with this ratio, but we saw a recent golden cross with this ratio. We really want to see this decline if the market was more certain about the fate of interest rates. We're still above the 2007 level right before the great financial crisis when we look at the 3-month yield. Our long-term charts, the special K is still positive. Be aware though that the weekly chart is still negative. Looking at our longer-term moving averages, we turned back up with the 150 and we're pretty much flat to slightly increasing with the 200. And we're a little bit above this resistance level on our weekly chart of the S&P. Can we stay above that and show more strength? We're seeing pretty much the same thing with the NASDAQ 100. We're above this resistance level now. Can it continue to go up? Then looking at the ratio between the NASDAQ 100 and the Dow, we're also getting a very high reading. We're almost getting back to the point where we were in 2000. This was the dot-com boom. After this happened, then we saw the dot-com bust. It took 20 years to get back up to this level. We'll have to see if this is going to pose some kind of a problem. An update of our possible positive scenarios. We're seeing the Qs outperforming the S&P, discretionary outperforming the S&P, large cap growth is outperforming large cap value. With our growth to value ratios, large caps and mid caps showing improvement, where we're turning up just a little bit with the small caps. The S&P to utilities ratio continues to go up, which gives good support to the S&P. When we look at the broad range of the 5-period moving average of the highs minus the lows, we are continuing to be positive. The growth to value ratio ticked down just a little bit and we're chopping sideways even though we're still in an uptrend. This is a bit of a concern. The 10-day average of the S&P 500 highs minus the lows continues to be camped at an extreme positive reading. The longer we stay here, the more that suggests there's good momentum. The 50-period exponential moving average of the new highs minus the new lows continue to advance. When we look at the next chart, the black line is the indicator. It's going up. The red line is what we use on the previous chart, and that's also continuing to advance. The Staples to S&P 500 ratio continues to decline, and that's giving good support to the S&P 500. What's our outlook for Wednesday? The technicals are positive, but we continue to be overbought, just like we were yesterday. We're getting the weekly MBA mortgage applications index. That'll be coming out. Housing starts and building permits. This could be rather telling because these tend to be leading indicators since you have to have a housing start and building permits before you can even start anything. And then we're keeping an eye on all the list of geopolitical events, but right now the market is fixated on inflation and interest rates. Here's the updated version of the economic calendar for the week. And then for the Stock Traders Almanac statistics for July 19th, we're neutral to negative with the Dow and S&P, where we're neutral to positive with the NASDAQ. We're on the 12th trading day of the month, where we're coming more into a period of time now where we start to see some monthly weakness. We're also keeping an eye on this other chart where the NASDAQ is also past the midpoint now and could be showing some weakness. So what about our scenarios? We're not going with the down one now, even though we are overbought. We're still defaulting to the positive side because the market is still looking strong, setting new 52-week highs. We're seeing some breakouts, but at the same time, we're also overbought. We're not going with the sideways trend for right now because our ADX is above 20. It's above its moving average, and that suggests we're in a strong trend. The warning signs, the longer-term trend signals. Are we signaling a top? Not right now. We're above both of those levels for the S&P and for the NASDAQ 100. We're coming into a seasonally and historically weak time of the month. The oscillators, they're still showing some negative divergence, but they're improving, and if they keep improving, we can wipe off this negative divergence. The VIX is still showing that there's not a lot of fear. We're still keeping an eye on the S&P to VIX correlation. The cumulative new highs, new lows turned up a little bit, but still are declining overall. We're still above the 3-month yield where we were back in 2007, right before the great financial crisis. S&P growth continues to weaken. Even though it's in an uptrend, it's going more sideways to down right now. And then we're coming into earnings season more and more each day. The positive signs, we still have seasonality and setups that remain in the background that are positive. The special K daily chart is positive, but be aware the weekly chart continues to be negative. Our longer-term equity put call ratio is positive since it's declining. We're still above the downtrend channel upper line. We're getting further away from that each day. We're still in a risk-on posture, meaning that folks are favoring stocks over bonds. Lower price levels may provide support. We haven't really fallen all that much, so far we can say that support is holding. The S&P is outperforming utilities, which often gives good support to the S&P. The NASDAQ and NASDAQ 100, they're breaking out and showing a lot of improvement. Can they stay above those levels? The Staples to S&P 500 ratio is declining, which also gives support to the S&P. The small cap index based on the Russell 2000 and the mid caps have generated recent golden crosses, but we're not seeing one yet with the S&P small caps. Small and mid cap growth continue to be positive, especially mid cap growth, and the Copic curve has generated a buy signal. So our conclusion, the S&P remains positive, but it is getting even more overbought. That applies to the short term and the intermediate term, but we're still positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.